Dead cat bounce to capitulation. 6 terms to know amid the global trade war. Number 1, bear market. A bear market is a term used when an index has fallen 20% or more from a recent high for a sustained period of time. Bears hibernate, so they represent a stock market in retreat. On the other hand, a surging market is a bull market because bulls charge. Number 2, dead cat bounce. When stocks rebound briefly in a moment of free fall, it's known as a dead cat bounce. It is said that even a dead cat bounces when it falls from a great height. The market recovery tends to be temporary and brief, and the downturn tends to resume. Number 3, capitulation. Capitulation is when investors accept their losses and panic sell out of fear. This tends to happen during times of low confidence and high volatility. At this point, the investor mindset only wants the losses to stop mounting. Number 4, recession. A recession is when the economy slows down and unemployment goes up. It's officially declared by a group of economists called the National Bureau of Economic Research. They look at things like jobs, income, spending, sales, and factory activity. They define a recession as a big drop in economic activity that affects the whole country and lasts for several months. But they usually announce it late, sometimes even a year after it starts. Just before Trump's latest tariffs, Goldman Sachs raised the chance of a US recession from 35% to 65%. But after Trump announced a 90-day pause on most tariffs, they took back that prediction. Number 5, buying the dip. Buying the dip means buying a stock or buying into the market right after it has lost value at a discount. However, no one knows exactly when it will hit bottom or how long the recovery might take. Lastly, number 6, 10-year Treasury note. The 10-year Treasury bond yield is the interest rate the US government pays to borrow money for a decade. It's a key indicator of investor sentiment and economic conditions, and it helps set prices for all kinds of other loan and investments. The yield influences borrowing costs and signals expectations about inflation and economic growth. Historically, Treasury bonds are considered one of the world's safest assets. That means investors often buy them when there's uncertainty in the market, which tends to lower the yield. Prices for 10-year bond tend to fall when confidence is high and people buy assets perceived as riskier, which causes yields to rise. In recent days, however, investors have sold Treasury bonds, which has sent the benchmark 10-year yield up. That could point to a lack of consumer confidence in Treasury bonds or other factors. That's all for today. Keep watching ET for more.